Hello, my name is Richard Crevo of Daily FX Education, and I'm here to talk with you today about how I use moving averages in my trading. Before I get into that, I just want to make sure that everyone's clear on how moving averages are arrived at, how they're compiled, what exactly they represent. Moving averages are nothing more than the average of the closing prices of a specific currency averaged over a specified period of time. For example, one moving average that I make quite a bit of use of, I have it on every one of my daily charts, is the 200-period moving average. And how that is arrived at is a 200-period moving average on a daily chart represents 200 days. The period on a daily chart would be a day. So to get the 200-period moving average, we add up the previous 200 days of the closing prices, total all those up, divide by 200, and that gives me the price on the chart where that particular moving average should be for that particular chart at that point in time. Now, if I were to go down to a 20-period moving average, for example, on that daily chart, then a couple things change. What happens is I only add up the previous 20 days, or it's only taken into consideration the previous 20 days. We add up the closing prices for the previous 20 days, divide that by 20, then we have our 20-period moving average. Now, moving averages can be faster or slower depending on the number of periods that are involved. For example, here's a rendition that I have here of the three moving averages that I probably use most often in combination anyway, the 20, 50, and the 100. And we can see that the 20-period moving average, seeing as it only averages 20 periods, is the fastest. That's going to be the most sensitive to price action, the 20-period moving average. Next is going to be the 50, and last is going to be the 100. So you can see the greater the number of periods, the slower the moving average is going to be. Now, there's a couple different ways that I employ the moving averages in my trading. One is like the 200-period moving average on the daily chart, for example. I can look very quickly at a chart with that 200-period moving average on it, and if price action is above that moving average and pulling away from the 200-period moving average, I know that the move to the upside, I'm going to be very bullish on that particular pair because the bias is definitely to the upside as price action is above the 200-period moving average and pulling away from it. Now, if price action is below the 200-period moving average and moving away from the 200-period moving average to the downside, I'm going to be much more bearish, on that particular currency pair. That's one way that I would make use of a single moving average on a chart to implement in my trading. Another way is, as I'm seeing price action on a chart, I might put several moving averages up on that chart and see if there's one that kind of fits the way price has been moving. Because if it does, then I can use that particular moving average almost like a level of support or resistance to trade off of. Let me show you what I mean. On this diagram right here, I've just drawn, let's say that black line, the 50-period moving average. And we can see here, the way I've drawn it, that price action has traded up to that 50-period moving average several times. Each time it touched that 50-period moving average, I could have shorted the pair because that 50-period moving average is almost acting like a trend line resistance, if you will. So each time it comes up and touches that particular moving average, I could short the pair and put my stop right above the moving average. This is another way that you can employ moving averages, and one of the ways that I use them in my trading. Now, at some point on the chart, price action is going to break back above the 50-period moving average, and then, of course, at that point, I can't use it this way to trade anymore. It's going to be negated at that point, and we'd be looking for the pair then to start to move to the upside. Now, this is why I've drawn this particular chart up here. What we have here is another way that a lot of traders make use of moving averages, and that being when the moving averages cross over. Anytime you see a faster moving average crossing over a slower moving average, that can be taken as an indication by the trader to buy the pair or to execute the trade in the direction of the crossover. In this instance, it would be to buy the pair because the crossover is to the upside. When the 20-period crosses over the 50-period moving average, many traders would take that as a buying opportunity in the direction of the cross. And then when the 20 crosses over the 100, there's another buying opportunity as interpreted by many traders. And then when the 50 crosses over the 100, that would be, again, another buying opportunity. One thing I want to point out to you here is, as the moving averages pull away from each other, as they begin to fan out and move away from each other, that's an indication that the move is strengthening. It's gaining momentum. Now, at some point up here, these moving averages are going to start to bend back over each other. And as the moving averages, as the faster ones cross over the slower ones to the downside, that can be a signal to exit the position. Obviously, things are going to depend more directly on what's happening specifically on the chart and with the pair. But just to give you a general idea, that would be the way that would work. Another way that I look at moving averages is as price action approaches, let's say maybe a fib level or a support or resistance level, I can look and see what the moving averages are doing. Do they look like they're going to respect that fib level, or they're going to respect that support or resistance level and trade away from it? Let's say maybe in this case the way it presents itself here. Or does it look like the moving averages are going to be setting up, gaining momentum to break through it? Like if there's a fib level right up here, right now, when I see this array of moving averages in this fashion, my thought is going to be that it's going to be breaking through, that fib level because of the way that they're set up. They're gaining momentum. I hope that provided you with some insight as to how I use moving averages in my trading. Thanks for listening, and good luck in your trading.